What's going on, guys? I'm Steve, and welcome back to the channel where we talk about the joys of stock market investing and long-term dividend gain. If it's your first time stopping by the channel, hit that subscribe button. Trust me, you won't regret it. If you're a returning subscriber, welcome back. I want to talk a little bit today about the S&P 500 and a lot of these ETFs that hold the S&P 500. And I want to give a little bit of insight of why I think they, in the present market, are the perfect opportunity to start your investment journey if you're a new investor or if you're trying to get acclimated with a lot of ETFs that provide value in turbulent market conditions such as now. A little bit about the S&P 500, and these are things that I didn't know about it. The S&P 500 was started in 1957. Since its inception, it has returned 10.5% return yearly. Now, give or take a few years, they've had where the S&P have been up and down, like present moment where the S&P is down, 20%. And, most likely it continue to be down by the end of the year. Like they've had, I think 3 or 4 years like that. But from 1957, on average, you get 10.5% on your money, your overall investment. Now, I knew about the S&P 500 before I started investing 7 years ago. It was one of the reasons why I started investing. From learning, when you first start learning about the stock market, a lot of times when they talk about the stock market, you have the NASDAQ, the Russell 2000, the Dow Jones, and you got the S&P 500. Those are the four main ones. A lot of times when they're talking about this market, like you'll hear analysts on TV say, oh, well, the market says this, the market says that. They're really talking about the S&P 500 because the S&P 500 is the most highly regarded index in the stock market, in the U.S. stock market. So that tells you a little bit about how significant that this index is in building wealth for you and a lot of other people, billionaires, millionaires and stuff, they swear by it. And we have the same opportunity, guys, as regular investors or people that want to get into the stock market as these people that are up there financially where we would like to be, or people that we idolize and look up to. Now, like I said, since 1957, its inception, it started and gave out 10.5% per year in returns. It's composed of the top 500 U.S. companies only. So that's another thing a lot of people don't understand, that the S&P 500 is only U.S. companies. It's the top U.S. companies. Another fun fact I didn't know about this, about the S&P 500 is it's constantly monitored, right, by a committee that all of these companies have to meet certain guidelines. I think it's monthly. I think it is monthly, where these companies have to fit these guidelines, and if they don't, they get booted out and new ones get added in. So basically, these companies that are in the S&P 500, without a shadow of a doubt, are doing what they can do to even stay in there. So it's almost like how you would have college football, college basketball, where you have your top 25 rankings or whatever, but the companies is top 500. Everybody trying to stay in position and still try to go up the polls. So it's a good thing to have. So that the companies that you're investing in are doing the best they can to continue to grow, and they're going to try to do the right things moving forward to stay in the 500, the S&P 500. What else can I say about it? Because the S&P 500 is used to determine the performance of most of the large companies in the U.S., U.S. Companies. Another thing is used as an instrument in bull and bear markets. And, history says, with a bear market, we have bear markets every 3.5, 4 years, right? So the situation we're in right now is nothing new, right? So a lot of times we get these statistics by reading the historical chart of the S&P 500. So it's almost like a history book about the stock market. Well, basically it is a history book in the stock market, of how the performance, and this is where a lot of analysts, they study this S&P 500 and they come up with these ideas of where they think the market's going to go. Now, the thing that's cool about the S&P 500 you can invest in the whole thing in the form of an ETF, right? An exchange traded fund. Now, I have S&P 500 in the ETF. Now, I go through Vanguard and I have the S&P 500 VOO, S&P 500 dividend ETF, right? And I think my expense ratio is like 0.03%, so it's relatively cheap. Now, you have a lot of places like Fidelity, and you have other places like Charles Schwab and stuff that also have ETFs. And excuse me one second. I gotta stop eating before I get on this camera. And they have these ETFs that you could invest in. Now, what's cool about the S&P 500 with these different ETFs, you know, if you guys go and do your research about it, I won't go really long into it. They have different types of ETFs, like S&P 500 ETFs. You have an ETF, S&P 500 ETF that's a growth ETF, meaning it's composed of S&P 500 companies, mainly the growth companies, a lot of the tech stocks and stuff like that. You can invest in that. You can invest in the dividend, S&P 500 dividend ETF, right? And this ETF deals primarily with stocks that pay a dividend, you know, and this ETF will have a high dividend return if you invest in it, you know, because it's basically comprised of the dividend traded stocks. Or you could do what's called the equal weight ETF. They have ETF, S&P 500 equal weight ETF. And a lot of people, you know, they'll say, what is equal weight? They don't know what that is. Equal weight is when, say, like in a standard S&P 500, right? 28% of the stocks that are in that 500 of them 500 companies are tech companies, which is like the top, you know, like the main amount, you know, of those companies are tech companies. At 28% out of the 500 is composed of tech companies. Like 14% is like healthcare, I think, and then so on and so forth. I can't remember all of that, but in the equal weight ETF, instead of it being like certain amount is this percent of the different stock sectors, right? It would give it equal weight. So instead of being 28% tech, 14% healthcare, everybody would get the same amount of weight per the amount of sectors that are in there, right? I hope I explained that right. But yeah, as an investor, if you are a beginning investor, and this is what I wanted to say, it's an excellent option for people that don't want to deal with looking at your portfolio every day, you know, dealing with the roller coaster ride and, you know, doing a lot of research. This is what a lot of people or a lot of financial advisors put their money, put their customers' money or clients' money into, because it never fails. One thing about the S&P 500, if you ask anybody that deals with wealth or investing, the first thing they'll tell you is you have to put money into the S&P 500 if they give you that information, you know. And the reason why is one of the things about the S&P 500 is it tracks the market. As America grows, the S&P 500 grows. It's like 80% of America you own with just buying it. So as America grows, so does the stock market, so does the S&P 500, because S&P 500 is the what? It's the needle that moves the market. So instead of dealing with a lot of stocks where, you know, you don't know what to pick, or you got to look at income statements, or you don't want to do any of that, you can invest in the index and just put your money, you best bet on America, and it works itself out over time. One thing is for sure, the market may dip every few years. You know, you might have a hiccup, but every time it comes back stronger. And if you look at the chart of the S&P 500, you'll see that the S&P 500 grew as America grew. Our technology, our healthcare services, everything else, it lines right up with the stock, because all these companies that are producing that are in that that index fund. So you can't go wrong with it, guys. You know, like I said, it's an excellent option. If you have little or no experience, and you want to get into the stock market, Hey, grab you some books, get on the internet, read about the S&P 500. They have now a lot of these S&P 500 ETFs, if you're not careful and you don't know how to do your research, are very, very pricey. Some of them $200-300 a share. But don't be deterred, because if you look hard enough and you go and look at like places like Charles Schwab and all these other investment accounts, or if you start an Ameritrade account or Robinhood or whatever, or just look on YouTube, the information is there, guys. They got some of these that track the same S&P 500. It's the same thing, but at a fraction of the cost. SCHD, I think, is one of them. And you can look it up, and it might be like $40 a share. But it's the same exact index, and you don't have to pay all of that money, But the expense ratio may be different. But I mean, either way, you can't go wrong with the S&P 500. Yeah. But guys, I just wanted to say a little bit about that. I was thinking about it, and moving forward, like I had made a video about backing off of stocks and stuff like that. One of the things I should have included in that video, and I humbly apologize, I should have mentioned that if you're pulling back from making individual shares, buys of share, buys of shares, buying shares of stock, right? Individual stocks, you still dollar cost average into the S&P 500. And I'm gonna tell you why. Once the market turns around and you say you can't time it, and then those best days of the market, where a lot of people miss, that really handicaps your returns when the bull market runs. If you're invested in the S&P 500, you won't miss out on that. And it's one of those things where, guys, I mean, by itself, the S&P 500 alone, just investing in it alone, that you can get rich off. Now, I mean, I wouldn't just invest in that. I would have like some type of like a bond ETF, like, BND, like Total Bond, Vanguard Total Bond ETF. And I would offset that as a hedge. I might go, depending on my age, 90% of my portfolio would be like S&P 500, VOO, and then like 10% or 20% would be BND. But as I got older in life, the percentage of VOO would come down as the BND would go up, and like you'd even it out over time when you're nearing retirement. But slow, steady growth. It's always going to go up. You're going to have turbulent times now where it's a lot of uncertainty, and a lot of people can't stomach that. And a lot of people are not long-term dividend investors. And by the way, these S&P 500 ETFs, they do pay a dividend. Maybe small, but they do pay a dividend. So you get some type of return on your money, especially if you reinvest it, which is advised. But my light and focus is going out. But yeah, one of these things, guys, man, I mean, when I was talking about the video, always jump into the S&P 500 or be wary of it. Because in my portfolio, one of my portfolios, I have 50% of the portfolio is S&P 500 as a fail-safe. I always have exposure to that. If you don't want to pick stocks, S&P 500, hell, pick them all. Get the fun. You don't have to worry about picking individual stocks, and you still get the great gains. Now, does it climb as fast as dealing with normal stocks? You miss a lot of that excitement where you get a quick jump, but if you're still getting exposure if it's in the S&P 500. So, guys, I mean, it's one of those things where if you don't have experience, you a new investor, man, check out that S&P 500. Now, am I telling you to invest in it? No. But I mean, it is very, very good advice to go out and look at some of these things. You can never go wrong with that stock, because if that fails, America does fail. Remember that. So, that's something to think about. But yeah, guys, man, like I said, I'm going to chime in as usual, drop a little bit of knowledge on you, give you something to think about. As usual, man, give me a comment. I know a lot of y'all that are listening to me got S&P 500, hands down. I'm not even going to ask the question. But I mean, if some of you are just picking stocks and you're new to the investing field, you got to check out the S&P 500. You know, until you figure things out, you know, it's very worth the investment and the time to study it and see how it works and see how it's right for you. Because if you do this thing right, and like they're talking about, the wealth transfer is going to begin soon, you know, why not be there with everybody? You know, I want to see you there. We can talk about it. Years from now on YouTube, you can hit me a comment like, yo, I remember watching you a long time ago, man. I took your advice. And, you know, we can laugh about it. Now, am I a financial advisor? No. But I know you can't go wrong with the S&P 500. So you heard me say it first. But but yeah, man, guys, just check it out, man. Don't take my, you know, what I say on face value. And see if it's right for you. But as always, man, like, share, comment, and subscribe. You know, I appreciate you guys riding with me. And I'll see you guys in the next video. Take care.